This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 64. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Chris Abraham, Chief Investment Officer of CVA Investment Management. I met Chris at an LD Micro conference and wanted to learn more about how he looks at the microcap market. In this interview, we discussed Chris's value-based option strategy and his thoughts on what's been happening in the asset management space. The goal is to learn about how Chris runs his fund and how that has guided his microcap investing strategy. Thank you again for tuning in to episode 64 of the Planet MicroCap Podcast. Please enjoy my interview with Chris Abraham, but first, a word from our sponsor. To my loyal listeners, subscribers, and fans, Robert Kraft here, your host on the Planet MicroCap Podcast. The 2018 Investor Conference season is upon us. Where are you going this year? I'd like to take a second to invite you to join me and some of the guests you may have heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 24 to 26, 2018 at the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you get to meet privately in one-on-one meetings with management of well-known public and private microcap companies. We are back with new surprises and programming that you will not want to miss. So join us for the Planet MicroCap Showcase, April 24 to 26, 2018 at the Planet Hollywood Resort and Casino in Las Vegas. For more information and register to attend, please visit www.planetmicrocapshowcase.com. See you in Vegas. For this episode of the Planet MicroCap Podcast, I have Chris Abraham on the program. He is the Chief Investment Officer of CVA Investment Management. Chris, welcome to the Planet MicroCap Podcast.
Thanks for having me.
It's great to have you on. So, for our audience, let's get your background.
Sure. I grew up out here in Southern California. For college, I went to UCLA. After that, I went to work at a tax advisory firm that used to be a part of Arthur Andersen. Got a good background in tax. After that, I worked at Nuveen Investments, a subsidiary called NWQ, domestic value-oriented firm. Got a great experience there. After that, I went to Chicago Booth for business school. Really loved my time out there, so now that's where I live. After that, I actually started my own firm from my experiences working there, interning at a variety of places like Ariel Investments, Mercer Investment Consulting, and for a little bit at Intel. Mm-hmm. And ever since then, been running my fund now for 3 years.
So, quickly I got to follow up. Who were you cheering for in the last NLCS? Was it the Cubs or the Dodgers?
Oh, Dodgers.
Yeah. All right, there you go.
I had to keep that quiet.
So Chris, how'd you get your start investing in microcap stocks then?
Sure. I think it was sometime in college. Funny enough, I've always really liked investing. I don't know what attracted me to it. Ever since I was a kid, sitting there with my parents, we would watch the news when we were little kids. The nightly business report was on PBS. And I didn't know what was going on. It was all these numbers talking about different businesses, but I just became more curious about learning things. And then ever since then, through middle school, I wanted to learn about business. And, it was mostly attracted to larger companies because that's what was in the news, that's what you saw. And then I think around college is when I started to say, oh, what are these small businesses that can really grow and that are doing really neat stuff? So that's probably around when I got interested.
And then so that basically from there just led you to, all right, I'm going to be studying this at UCLA and the whole track, right?
I think I knew, as weird as it might sound, when I was much younger, I think in middle school, but I didn't really know that I could do it for a job until college. That was the weird, I was like, oh, you can get paid for this. Because I didn't think I would be doing that full time. And so that's when I started to explore different areas. And then microcaps were just an area that was just underfollowed. Not as many people were there. And that's kind of what attracted me to it because everyone was focusing on the big things. And I was trying to find what are the opportunities that people might be missing.
So then what is your criteria then for a potential new investment in a microcap stock? How have you developed that over time?
That's a good question. When I first started out, I was really interested in deep value, special situations, some of the parts analysis saying, oh, look, this is trading below the value. It's real estate. You're getting the business for free, etc. And over time, I've kind of learned you can make money doing that. And there's a lot of guys that do a great job at it. And occasionally I'll look at that if it's really dirt cheap. But it's a really hard way to make money. And there's a lot of ways you may or may not be right, and it could take forever to play out. And going through those experiences is how I kind of said, you know what, this is brutal. this is hard. And that's where I got more attracted to being disciplined and sticking with more quality names. And within microcap, there's a lot of startups, a lot of unprofitable companies. They're heavily reinvesting, raising money to do that. And so once I started narrowing it down, it became much more manageable where companies had good balance sheets, good management, had good incentives. And that's where I could kind of say, look, instead of there's 100 companies at this conference, there might be 5 or 6 that look really, really great. And if I can find 1 or 2 that are home runs, that's worth my time and make a concentrated investment.
So you hit on a couple measures that you look for there, management pay, a couple other things, so just to kind of lay it out, what are those criteria that you look for when you're scanning that list at a conference? You're like, okay, these are my 5 metrics that I go after, whatever.
So I actually go through every name.
Oh, okay.
And because a lot of them I've never heard of before, like on OTC, I was checking out yesterday, there's over 10,000 securities listed on there. And so there's all the time you'll find a new company you've never heard of. So when I go to a conference or if I'm reading, I'll just look at it just to see what they do. Maybe I've met the management before at a previous company. So I'll say, oh, these guys are smart. I know nothing about the company. I'll just go sit down and catch up and see what they're working on now. So ideally, I like companies that they have a good growth runway. They're in an attractive sector that even if they may not execute perfectly, the fundamental tailwinds of the sector can carry them as well. But if you have good management, a good growth runway, and an actual profitable business model, that's kind of what I look for that can carry these companies from microcap and hopefully to small cap and bigger. Unfortunately, what happens sometimes is they're so good they end up getting bought out. So they never reach small cap status. So those are the ideal ones that I like to find where if they have those good balance sheets, good cash flows, run by good management, you can sleep at night as well. Because there's a lot, and especially in microcap land, there's a lot of unforeseen things that can happen. Business changes, life happens, and then you can get involved at a good time when all the fundamentals are working and things will work itself out.
So then what's your strategy after identifying a potential new investment? So let's say whether you're at going to a conference or not, or, you're sitting at your desk and you see like, oh, it met all my criteria. What do you do next?
Then I have everything on a watch list. So right now I have a ton of names on my watch list, and then I'll have a more concentrated short list on things that meet the valuation side. Okay. So there's a lot of quality names that I follow that they're just not cheap enough or I'm not ready yet. But then once I narrow it down on the other side to maybe 10, 15 names, I'm ready to buy this if there's a big down day or there's something going on, if it drops on earnings or something bad happens. So those I'm just always watching because in microcap, one day you might be on the plane and you get off and you see a stock's down 20% for no reason because someone's liquidating or something, someone puts in a market order. So that's when you just have to always kind of just keep an eye on it or set up alerts on your phone. So that's kind of why I have how I manage my two lists.
And then so I guess we may have skipped a step because, let's say you identify it and then it immediately goes on either one of the watch lists, or do you do any type of qualitative follow-up, like meet with management, all that kind of stuff?
Sure, yeah, absolutely. For due diligence, I'll try and meet management if I can. Some managements don't want to talk to investors, which is okay if they're doing their work. The proxy statement and corporate governance is pretty big for what I do because I think one thing you learn is that you're a minority holder in a stock. So you don't control the cash flows, you don't control the direction of the business. So you have to trust management at the end of the day. And there's a lot of decisions they're making that you don't get to see that are hidden. So even if they own 20, 30% of the stock, I've come across many microcaps where management is paying themselves very generous salaries and bonuses. They're funding their nonprofit charities through the company. They're gifting shares, doing some things. So once you get to know them, you see their track record, you gauge their trustworthiness, make sure they have the right incentives through the proxy statement. You see their capital allocation. Are they reinvesting in the business properly? Are they not starving it? Are they, buying back shares appropriately? Or are they not overloading the company with debt unnecessarily? So those are on the management side. And then the rest is kind of understanding the business model. How profitable can this business be? Is it sustainable? And then the last part is kind of just understanding, like I mentioned, that growth runway. If you're in a good business, you can keep growing for a long, long time, and you can earn those returns on capital. And that's where you can really make some great money. Whereas a deep value situation, like I mentioned earlier, you might be just playing for a reversion to the mean and a quick gain, things like that. But if it's a declining business or there's not much there, you could hold it for 5-10 years and your gain is kind of capped. Whereas a growing secular industry, you can also gain share in there. That's where you can really make a lot.
So, actually, I may not have asked this question before. I'm pretty sure I haven't. But even if I did, I'm going to ask it again. So how do you calculate that growth runway? What is your philosophy behind that?
It's obviously imprecise, but it's areas with good secular tailwinds. So I'll give an example. The pet industry. Okay. Everyone loves their pets. People spend any amount of money on all sorts of accessories, necessities, things like that. So there's different niches such as vets, retail stores like PetSmart used to be public, Petco, there's accessory companies. There's also there's WAG, there's Rover. There's all those companies that are doing dog walking now. So those are areas where in the pet industry, it's a great place to be. And then you have to find your niche where you have a competitive advantage and where you can grow. So if you have that secular tailwind, you'll be in a good place. Now, if you find that niche within there, that's where some magic happens.
So for you, how do you then find that niche or that secular tailwind that is, I'm going to look a little bit closer here at pets. Why pets? No, I'm not asking pets in particular, but
Sure. It's a lot of study about a lot of different areas. You talk to a lot of managements, you talk to a lot of people. More than management, I prefer talking to middle management, employees everywhere, because they're really passionate about what they do. They know their area. Some of them are experts. They'll tell you, hey, you don't want to be here. This is an area you don't want to be in. This is an area that's going to be growing, and this is going to be profitable. This is not profitable business. So I try to find people in different sectors that know way more than me and say, okay, I need to do more research on that myself and judge it. And that's where I get a lot of leads. And then there's areas that I'm partial to where I think, okay, this is a good area. This is where you want to be over the next 5-10 years. Because I think in some places we can say, you know what, over the next 5-10 years, this is probably going to happen. So for instance, asset management, it's probably a good bet over the next 10 years, fees are going to come down. And how is that? From there, you can kind of back into the industry, see what's going to happen. Then once you talk to each company, you can get a better idea of, okay, what's going to happen to the equity side? What are fees going to happen here? How is ETFs going to affect that? What's going to happen with mutual funds and loads? So there's a lot of different areas you can start at the industry level, or you can start at the company level and say, hey, this is a really good industry. So you can back into it either way.
That's a good segue because And my comment on all that is that, you start down one rabbit hole and you can just keep on going and come back up and then go down another one as just as easily.
So true. That's actually how my days are. Well, you just go down different rabbit holes, and sometimes it doesn't work out like you think it is. But every once in a while you strike gold and you're like, wow, this is really something. And if you find some companies within there that you never heard of, you're like, wow, this is going to be really interesting. Now that's when you start the due diligence that I mentioned on the corp governance, the capital allocation, et cetera. I
was going to say that's our theme for this interview today, because I have so many topics I want to talk to you about. When we met at a recent conference, I think that's what happened to us. We ended up just talking about so many different things. So I thought, what, we gotta translate that to the podcast. So we're starting down one rabbit hole right now, and it actually ties into something you were alluding to regarding ETFs. And I think I had this one question, about the ETFableness of microcaps. Can you comment on that?
Sure. A few weeks ago, I went to the National ETF conference they have out in Hollywood, Florida. I've gone the last few years, and it's actually more of a product and marketing conference, more than an investment conference. And there's a lot of advisors there trying to figure out, okay, do I replace individual stocks in my portfolio? Can I replicate it through Vanguard and BlackRock? And so I go as an investor to kind of gauge the asset management industry, look at individual companies, see what products are going to affect equities and so on. And for me, I enjoy that from a personal and business point of view. And for microcaps, like we were talking about earlier, I wanted to see how much are microcap ETFs or active institutional mutual funds affecting the business. And for ETFs, they're not active yet, at least on the micro side. They're just passive. They track the Russell Microcap Index. So the BlackRock fund, which is the largest, the symbol is IWC. It has 880 million.
Just for full disclosure, are you a shareholder?
I don't own or never have owned that ETF, but it has 880 million in assets as of a couple days ago. Yet that's a massive fund. You can't really invest in microcap very usefully. But when I looked at the top holdings, because I just wanted to see, does this actively track? What are the positive attributes or negatives? And if you look at the top holdings, the top holding is Anapsys Bio, which I've never owned or do not currently hold. It's a 2.8 billion market cap. And then if you go through the rest of the top 10, it's 2 billion, 2 billion, 2.7 billion, and so on. And these are not microcap companies. And yet there are family offices, advisors, a lot of retail that own this, thinking that they're getting microcap exposure. And my point coming back to this is, if you raise too much money, you can't effectively invest in microcap because you just get too big. And that's something that active funds and ETFs are having trouble with. So when you raise so much money, you can't do microcap. And that's where I think if you're even a retail or small funds, you have a huge advantage where you can have concentrated positions in sub 50 million, sub $100 million market caps that these guys can't touch. And everything they're doing is rules-based. So when they're buying it, they have inflows, they have outflows, they're buying proportionate positions. And that's where you can find a lot of gaps. So that's another reason why I look at this, because as ETFs are growing so much, at least flows into them, that's going to affect how we look at our stocks. They could become bigger and bigger holders in our positions. They might buy, just drive up the stock because they have to fill out the position of the ETF, or if it's an outflow, they may drive it way down and for non-fundamental reasons.
So in essence then, I mean, can you create a microcap ETF, or is there just way too much risk?
It's a great question, and that's something that I struggle with. And even from, if we think about spitballing and saying, can we create our own business? And I think that it's a catch-22. I think you can at a limited size, but the problem is once you get big enough, you can't replicate any microcap index properly because you get too big if you're successful. Right. Just like this BlackRock fund has been successful in raising so much money, they have to move up in market cap, and they're in a couple $1 billion small cap companies. So I think that's one of the advantages us as active managers have, is that you can't accurately ETF the microcap universe, in my opinion. Maybe I could be wrong. I hope I'm wrong at some point, but I think just the way the market works, it's really difficult.
So Another question I have, and this is related to your answer that you just gave, is this idea of an institutional microcap perspective versus emerging managers. It seems that, especially in the microcap space, there seems to be an advantage to the retail investor as well as the more smaller fund manager. Can you comment on that?
Sure. It's I've been fortunate to work at a couple of larger small and micro funds in the U.S., and I've gotten to know a lot of the institutional fellows in the business, and they just have a different structure. Because I'll say if you run $100 million, for example, that's much less than some of these guys manage. And if you want to invest in a 50 million microcap and
buy the thing,
right? And if you just want, let's say, a 3% position of your 100 million fund, you're already a significant holder. You're almost a 10%, 8% holder. And that it's going to take a long time to build that position. If it's illiquid, it's going to take a long time to get out. So from just a practical standpoint, they just can't do a lot of things. And that's only at 100 million. That BlackRock one we mentioned was 900 million. Yeah. And so some active managers, if you manage 200, 300 million in AUM, it is really hard to do that in microcap. I think you start reaching, if you're doing sub $100 million companies at a concentrated level, I think you start getting into trouble at 50, 75 million. Just because when you're trying to deploy that amount of money, it's hard. Because some of these stocks, they may trade a few $1,000s a day. It could take a year to build a position, which smaller funds in retail, they're patient enough and they can afford to do that. So I think that's one advantage that smaller funds and retail have over institutional guys, because they just have different, and they also have mandates that they have to meet. Some of them have minimum market cap restrictions. Some of them have liquidity restrictions. So that causes them to shift up market as well, almost similar to the ETF. Or because they're such small market caps, you have to hold too many positions. So if you run a 100, 200 million fund, you might have to hold 100, 200 positions. And then the question is, what's the effectiveness of that? Like we were discussing, a retail person has no problem holding a 10 or 20% position in something they think is really undervalued. A $200 million fund can't do that. They might have a 1 or 2% position.
So, I mean, at the end of the day, it's like, it's interesting. I mean, wouldn't you think some of these larger institutional funds would have, maybe allocate, like even if they raise 100 million, maybe they have the smaller, like, 10 to 20 million just for their microcap fund. Like, have you been seeing that out there? Or
I have seen some funds that have raised separate accounts, or others where they said we're going to have a dedicated $30-40 million microcap fund. And they've done well, and you can do okay with that. The issue, though, is it's hard to build a firm just with microcap money.
Interesting.
Because if you're trying to build a big business, you can only, like I said, manage well maybe 100, 200 million max in microcap, where it gets difficult. Maybe some people can do 100, 200 names. For me, I can't do it personally. I have a much smaller portfolio. I like to be concentrated. And so if you're building a business, if you want to hire a couple analysts, do things, the economics become really hard from a business model point of view. So that's why a lot of people who are successful in microcap and they raise 100, 200 more million dollars, they say, they graduate. Right. You graduate to small cap and say, oh, great, now we can raise a couple billion or more. And so that's what ends up happening in asset management, funny enough, where if you're great, you just keep moving up. And when you get to mega cap, you can raise tens of billions. Right. And you can hire a lot of people and have a great empire. So that's, I think, another, aside from the restrictions and mandates that apply to micro, is that just from a business model point of view, big asset managers, it's not really worth their time to do a microcap fund. Because if you run a couple billion small cap fund, okay, you raise 100, 200 million micro, that's it. Yeah. So why waste time there when you can say, let's spend all our time on marketing our small cap fund and raise hundreds of millions more? Right.
So what's the main drawback you're facing, in your business?
Even I have trouble buying some names that I want. I was just looking at my phone, and one of my names I love, it's traded $5,000 worth today. And I'm hoping to become one of the larger holders, but it's going to take me a long time to get this company. And it's trading well below replacement cost. It's a great business. But because it's so illiquid, I know that everyone else just writes it off immediately.
Right.
So on the institutional side, I know they're not going to be in there.
Right.
There's one ETF in there, so I know that's a rule-based one that went in. So I think that's hard for me already. So that's why I say I know that once you get bigger and bigger, they're going to have huge problems. And that's why they graduate to 100, 200 million caps, which are a lot more liquid. Other challenges are probably maybe just getting information. That probably takes a lot of time. So you can do all the legwork. It's just a time commitment.
Right.
And kind of dovetailing on that, we're talking about institutional versus emerging managers in retail. I wouldn't say they have an informational advantage because Bloomberg and FactSet and a lot of the Reuters, they don't help you in microcap.
No, I can tell you from personal experience, just, my I'm getting my MBA right now, and in my finance class, we're doing our stock project where we're, doing all the whole thing, and our professor is basically saying, just go through value line and just pick one from the 1700. And he goes, I've been using this for years. This is what everybody uses. And I'm thinking to myself, like, I really wanted to do a microcap, but I'm like, okay, wait, I got a month to do this. I'm running, I was like, oh, okay, I know I can't. I'll just do one of the ones on the 1700. But it got me thinking more, where I was like, oh man, there's no real data set that is put together like a value line for microcaps.
You're absolutely right.
Do we have a new business? I don't know.
Hey, trademark. No, that's a great point. And that's, what happens. I was in, I don't even remember which service I was using the other day. The ticker won't even come up. Oh. So some of the services, if you type it in, you can't even find it. So you literally have to go to the company websites. You literally have to go to sec.gov, or some are dark and not reporting all the time. That's more rare. But institutional guys have to do that too. But I can tell you, having been on that side, a lot of times they're lazy and only want to use sell-side research. So if there's sell-side that happens to cover some of these microcaps, they may get involved. But they're not going to do the extra digging to go through a lot of these microcaps. They'll say, because of their liquidity and other restrictions, they'll say, oh, is there coverage? Can we look through it in FactSet or here? Because there's so many names out there, so because you have to narrow it down, what are you going to default to? You're going to default to a few easy ways to either screen for them in FactSet or Bloomberg or some other way. But some of these, the screens just don't work properly, or microcap, it's just all over the place. So I think that's actually an interesting thing, where even if you pay whatever it is for a Bloomberg now, it's not going to help you that much in microcap. And I think that's a huge advantage, where if you're retail or a small fund, if you do all your due diligence, by the book, travel, meet companies, you're beating 99% of people.
You know what's crazy, and I think I've talked about this before as well, is, you would think, you have your Buffetts, your Mungers, all these incredibly famous investors that really got their start in microcaps and using a tried and true value investing strategy, where, everybody has their different ways that they, manipulate that for their own use. But it's still just unfathomable to me that, like, this isn't something that more people would employ and want to do, and there's many different reasons why, there's a lot of extra work that needs to be done. Maybe there's active managers that don't want it to go out there because they want to, they want to keep that edge. But, in your opinion, what is it? Like, why hasn't it hit? Why aren't more people doing this? It's been around for years. They teach it in every business school class.
I think it's a variety of reasons. Like, you hit on a few of them. I think there's structural reasons, behavioral. It's not in the news. It's not interesting to people. A lot of businesses, it's the same old thing every day. Look, I was looking at the news for one of my microcaps. I think that I was on my watch list was down 15% the other day. I was like, okay, great. No, there was literally no news in the past year except 4 earnings releases. There's 0 press releases. And
it's a very conservative one.
Yeah, and they just don't, there's just not a whole lot going on. They just do the same thing every day. And I think that if they're not on services, people say, oh, there's not sell-side research. That's kind of a quick fast forward so I can get up to speed on the company without going through all their source documents. And I think also from a business point of view, like we talked about, you just can't raise that much money and do a good job in microcap.
Right.
And so because of that, there's limited interest. There's interest for a while, and then once you're successful, you're done. And because you can't do so many fun individual microcap stocks well. You need to hire too many people to do the groundwork and legwork. So I think it's a lot of structural reasons. Behavioral, I think there's some there that apply to large cap as well, but I think a lot of it is just the size. It's just that people lose interest, or it's hard to figure out.
But even on the retail side, like with the crypto craze, everybody was, myself included. I'll be the first to admit, especially because it was in all the news. First thing I went to was look at all the penny cryptos and see what was there and what was available. And I have a ton of friends that's the same exact thing they did too. And I took a step back thinking to myself, this is what I did with microcaps as well. But people who have that same excitement about, let's say, cryptos or any asset that happens to be the new thing, why aren't they then using that same type of logic and saying, oh, well, let me look at the stock market then. There might be something here as well.
That's a great point. I think it's personality driven. So for you, you were instantly attracted to those small ones and saying, hey, these have the most potential, or they could be, whatever it is. And I think a lot of people, they may think about stuff they use as consumers or what's tried and true, and they may be more attracted to that stability or what they can understand. But I think to do microcap, it requires a little more, you have to be a little more entrepreneurial.
Sure.
You have to be willing to go hunt down and find things that may or may not exist, and it's a little different. So I think that's where a behavioral and point comes in, where it's more personality driven. Because we've met a lot of characters in microcap. Sure. It's very different than a large cap conference. I'll tell you that. It's a very different personalities that are involved, what they're looking for, how they approach things, and it's fun. So I think that's where you have the business side, you have the behavioral side, structural. It all kind of plays in, and that's kind of where we are, why the market is why it is.
That's a good segue to my next question, because another thing I wanted to talk to you about is that behavioral and structural issues in microcap investing. I mean, you hit on a few key points, especially on the fund side, but what are some of those personality traits that we see at all these conferences that kind of lend itself to microcap? So, because there might be some people who are listening and be like, I don't know if I was ever really, I don't know if I have the mindset or the discipline, because you really do have to have a lot of discipline, I think, to some degree for microcap investing. So, what are some of those characteristics, and maybe how can people adopt them?
Sure. I think there's a lot of risk taking.
Sure.
Whether it's financial or career risk. Because people are putting a lot on the line when they're starting a venture, how they're, saying, hey, this is my financial and my occupation. I'm putting everything on the line. And then there's others where they may be just completely different, not just necessarily publicly traded venture capital businesses, but they're just small businesses. That they might be industrial ones, consumer, real estate, but they just are in one locality. They might be in Orange County, or they might be in Chicago or New York, but they're only in one neighborhood, and the family or whoever's running it just hasn't had that interest in growing it. So as an investor, you might look at it and say, you know what, I'm really attracted to this situation. This interests me. These ones, I don't really understand these biotech names. I don't have a science background. I'm not into that. So I think a lot of it is personality driven, where, I'm very interested in this, or you know what, this is small and risky. They have one product. I don't get it. I'm going to stay away from it. So I think within the range of microcap, it's interesting because you have that range of personalities where you have these guys that are pretty brash and starting new things, trying to fundraise. Then you have other guys that are actually quite conservative. They own real estate and don't have a mortgage. Like, they're that conservative. And I met a lot of these guys. And I'm like, why don't you want to get a mortgage? I'm like, it's 3 or 4%. You can reinvest it here. You can buy back your cheap stock. There's different options.
Just to clarify, you're talking about management.
On the management side. And they're like, this is just, we don't feel like it. We don't want to. And so as an investor, you can find those more venture capital-like investments that are starting out, if that's your personality, or you might be attracted to a lot of conservative businesses in microcap. So I'm more attracted to a lot more of the conservative ones, or the ones with a good base that have good potential to grow. The speculative ones can work out, but the variety of outcomes are very wide, and I prefer a little bit more narrow and a little bit, kind of taking away the tail risk, so to speak. So my personality has been driven more toward those type of companies, whereas I know other guys are more interested in saying, oh, what could this be? It's a new cure for this, or it could be, some newfangled thing in industrials. So I think that's where people just should say, hey, what attracts me to this? If these aren't interesting, don't do it.
Right.
Because there's plenty of large companies that are great, but I think in microcap they'd be like, you know what, this is in my neighborhood. This is a small company. They own a few warehouses here. Let me go learn about them. So I think that's where do you have that entrepreneurial nature and finding something you enjoy doing? Because those are the two things that'll make it much more fun. Whereas if you're looking at some sectors you don't care about, it doesn't matter. It doesn't matter micro, large. You're not going anywhere.
Yeah, I mean, at the end of the day, what it comes down to is, you have that entrepreneurial spirit and also you care about your finances and wanting to build wealth. I feel like that's something that you really have to feel if you're going to want to get into microcaps. Otherwise, you're going to be bored as hell reading that SEC filing,
And you can get a little more involved in the business than you think. You can attend the annual meeting. You might be one of the only couple people there. You can actually get to know management, talk to them, learn about the business, especially if you're interested. So this could manifest itself in a lot of ways, not just making money, but you'll have a really good time because you'll. Right. And then if they start a new business, or you might find some new things that are interesting, you can go into that. So like we were talking about rabbit holes, right? Sure. You just go down a new one.
So we just covered behavioral issues in microcap investing. Now, another thing I'm curious about now is, structural issues that you're seeing in microcap investing in terms of the infrastructure that facilitates, investors meeting with companies and potentially new, maybe a lack of new companies coming on the scene. What are you seeing?
I think in the overall market at large, there's been a good amount of studies and articles written talking about how listings are going down in the overall market. But I think we mentioned earlier, OTC has over 10,000 securities listed. Some are ADRs of foreign companies that are large cap, but I think there's a lot of potential areas in there that are still there to invest. So I don't think that's a problem. As far as structure, I think one of the things that I notice when I'm trying to buy some illiquid names is that, let's say the stock is at 20 and the bid ask might be $19.50 to $20. I've noticed many times when I put in my order for $19.50, a limit order, all of a sudden it's $19.51. So I know in large cap this happens a lot more because the bid spreads are small or there might be a few cents, but I've seen that a lot more in microcap. And as I've started to get bigger, I mean, I'm a minnow compared to some of the much larger funds, but that's something that I'm like, okay, who's doing this? Which market makers are getting involved in playing these games? So that's where I think market structure, I'm kind of curious on the microcap side. I'm not an expert in that area, but I'd like to know a little bit more about how is that affecting prices, volumes, things like that. We were talking about ETFs earlier. I wonder how much more influence ETFs have today versus 5 years ago. How much of the volume is them? And then from a structural point of view, like just meeting companies, doing things like that, I think it's just the same as it's always been. There's some managements that will talk to you, some that won't. You have to do your due diligence, go in there, find your margin of safety as well as you can, at least from a fundamental perspective. If you're a different type of investor, I'd actually be curious, growth investors, guys that are doing more startup type things. How are those working out in terms of the current financing market for them? Because from what I've seen, a lot of them, it's become a lot harder. Like the haves have become much stronger, and the have-nots, it's become a lot harder in microcap to raise money. Even though the economy is doing great, it's really interesting to see that bifurcation.
So another question I had, and I'd love to get your perspective on this running a microcap fund, what are some of the implications for the tax cuts that just recently happened in microcaps? Not tax cuts in microcaps, tax cuts in general. But Sure.
So one of the good things about the tax cut is a a lot of my tax knowledge has gone away over the last 10 plus years, but now that it's all new, we're all on the same page. So if you're new to it, we can all learn together. But for microcaps, since they're mostly domestic, it's going to be a pretty big positive for the ones that are profitable and have some type of competitively advantaged business, because their tax rates are coming down. They have an advantage in their business. They're not going to compete it away necessarily in their local communities. Big companies, it's probably a little bit different because it's more competitive. There might be some competing away. I think banks, it'll probably be less competed away. So for community banks, I think it'll be a huge, huge benefit.
So another thing I wanted to ask you, and it's something, again, that we haven't discussed too much on this podcast, are option strategies. And I was doing some background research on your firm, and I've seen a couple interviews that you've done in the past, and you've discussed this idea of a value-based option strategy. What does that mean?
Sure. It's kind of using options as another tool to express your investment. So if we think a stock is mispriced, options are just another tool where we can take advantage of that mispricing. And one of the big advantages is we can limit our risk. So we can sell, if we think a stock is cheap, we can sell put spreads, for example, and we would do a spread instead of selling naked put options to take away that tail risk in case something wacky happens. We could buy long-term calls, leaps on some of these really mispriced names. So because it's a derivative, it's just one more level of mispricing. And you could get some more leverage on the upside, or bring in some income on that. And that's just kind of how... One reason we've come to do that is our business model is by selling these put spreads or buying these leaps, or more on the put spread side, we're creating float. So one of Buffett's greatest things he's done is he's made his money not just investing in high quality businesses, which is what 99% of people focus their time on, but he has a constant stream of income coming in that he can deploy. Whereas institutional managers, unless you have inflows, you're pretty much just reallocating from position to position. And that can be great unless you start getting outflows, and then it's tough. So I've tried to model our business where we can kind of create inflows where we're not necessarily dependent on constant inflows or client money to run the company.
Interesting.
So that way we can not only, so the option side depends on how good we are at, because options at the end of the day are insurance. Sure. How good are we at underwriting the valuation of certain companies and selling that insurance on them? And that's how I try to control it where we're not taking too much risk, but we're generating income that we can deploy into these cheap companies and keep going. And then the third, I guess, part of the triangle, I guess you could say, is deferring taxes as long as possible. So if you own these high quality companies and they're secular growers, good areas run by good people, you can get that long-term value creation by deferring taxes as well. And you can keep compounding. Because if you buy these deep value names, which I learned about early, yeah, maybe you make 50%, but you lose a huge chunk to taxes, especially selling within a year. And you have to generate so much more returns year after year if you keep buying and selling rather than owning a great company for multiple years. So kind of all those lessons I learned, I tried to apply it to forming my business and saying, okay, what is a sustainable way of not only running our fund and our business, but what type of companies will lend to the most value creation over time? And just from math, I thought the compounding is the way to go versus, and also it's a little bit easier physically rather than finding those, returns every year and turning over the portfolio so often.
Why don't more funds adopt this type of strategy, or do they? And I'm just naive.
It's a good question. I think maybe a few might use options in different ways, but I think everyone focuses their time on the investment side and not on maybe the business model or others. Because one thing, especially starting out a fund, that can be a whole new conversation, but everyone spends so much time on marketing and starting a fund, getting investors. Sure. And for me, I only have so much time between sleep, family, friends, investing, doing what I like. Most people cut out sleep and probably maybe a little bit of family, a little bit of friends, others. And I was like, you know what? I'm going to cut out marketing, because I tried to learn out the lessons from a lot of what other people were doing. And they were on the road all the time doing pitch books, and they might get a few investors here or there, and for structural reasons, it's hard to allocate to emerging managers. And I said, okay, how can I run this as a business without, making my time a little bit more how I want to use it? And so that's kind of how I came up with the idea of, okay, how can I create some sort of float or some other way of doing inflows? So that way I can get clients through referrals, which is very efficient for them and me, and I can also build the value of the fund.
It also makes sense because if you don't have that and you are just focusing on the investing side and you have to turn over your portfolio every year, you're sometimes having to sell a name that you probably don't necessarily want to sell, but you have to in order to make sure that you have enough to allocate for the following year.
100% correct. And having seen that when I was on the institutional side, it's tough because you have to make... When you have to make
the company too sometimes.
Absolutely, especially in the microcap, right? And one of the toughest decisions is, this company's cheap. Which one is slightly cheaper that I have to reallocate out of or we have to move? And if you have inflows or outflows, those are not the easiest decisions to make, because what if we all know if something might be undervalued, but what degree? Is it 30%, 35% undervalued? This one's 45% undervalued. It could be, that's within a margin of safety, or if a small discount rate changes, you could be completely wrong. So that's why, if you can, you want to hold that as long as possible and let everything grow into it. But asset managers, insurance companies, sometimes they have to make those tough decisions. And like you said, they have big tax consequences.
Oh, man. If microcap companies didn't have to face enough already, they even when they get that investment from a fund, it's like you're just at the mercy of them and potentially being left out for their reallocation.
You're so right, and that's where another thing that we looked at to get more float from just options is ETFs. So there's some ETFs that we've seen that track what they're supposed to track well, and some not as well. So there's some ways where you can maybe go long one side, short the other, create some float, and you can actually take advantage of those arbitrage possibilities. So those are the ways that I've tried to position the business, other than just traditional value investing. I look at this more as analyzing products, more than analyzing companies, and it's just another way of kind of adding value to the fund and our clients.
So then, this is one of my favorite questions to ask. What experience, and you talked quite a bit about a few of your experiences, but maybe what was one experience specifically that really helped guide your microcap investing strategy? Something that you were asked to do or that you saw, you don't have to name a name of a company, but just that you're like, okay, the mental note, February 21st, 2003, you know what I'm saying?
I think the lessons that I learned at my old asset managers and what friends did at their companies taught me a lot. I don't think I have anything specific, but I'll give a few examples. Some of these deep value names they took up a lot of time. They're very time consuming. Whereas if we identify, a great microcap company, good balance sheet, good management, and it can grow for a while, the funny thing is it doesn't take long to do that analysis. The hardest part is the discipline of buying or trimming or letting it just keep going. And what happens, especially in an institutional environment, you spend 90+% of your time on problem children. And you're just like, why am I doing this? And we were talking about the returns of, you're talking about turnover every year. And you back into it and you say, why am I doing all this for such a little return over time when I'm spending 10% of my time on such great things that are providing most of my returns? So I learned to kind of cut off what I wasn't as good at on the deep value side and saying, you know what, let me spend little to no time on that and spend all my time on the stuff that's that's worth all my returns. So that's probably one of the biggest lessons I learned is stick with what you're good at and try and cut off the stuff that's killing your returns. Because even if you don't improve your returns very much on that side, if you cut off your bad stuff, you're already ahead. And that's one of the biggest lessons I learned through multiple names and over time seeing what to do.
Yeah, time management can definitely be incredibly crucial.
Absolutely, and that's something where in the thick of things, you don't think about it. Like when you're looking at a deep value name, you're just saying, oh, I need to figure this out. I need to talk to them. Oh, yeah. But then when you take a step back,
news releases from like 10 years ago.
All sorts of arcane things. I mean, I became a credit analyst during the financial crisis. I was looking at a lot of things, a lot of credit, and it was a great experience. I learned so much, but that's when you say, why am I doing this? You take a step back and say, you know what, I have these great companies here that require my trust, my evaluation of their judgment, the business. That's a completely different calculation than doing looking at heavily at financial metrics, financial covenants, all sorts of things. And only once I took a step back and actually thought about it clearly, I said, this is a much better use of time. And also, it kind of cuts down on my bad investments.
So then what advice would you have for new microcap investors out there?
So a couple of things I think that are really useful are network, like come to your guys' conference, come to other microcap conferences. You'll meet a lot of other investors who will teach you one thing. You'll meet companies who will teach you another thing, or you might learn things you like or don't like. So that's a good place to start in terms of networking. In terms of looking at companies, I would say, like I mentioned before, find your passion. Find out what interests you, because then it won't feel like work. Because I'm sure a lot of people have day jobs and are doing other things. It's hard to look at companies if you're not interested, especially after a long day of work. No one wants to do that. But if it's something that you find interesting, you can stick on it for a long time. And I think if you do that with combining with networking, that's a good place to start in terms of figuring out what your interests are. A great resource I like is Twitter.
Me too.
Twitter is great. There's a lot of really smart people on there. I mean, there's obviously a lot of funny business, but there's a lot of people, you can tell when they're writing things or saying things, they know the business well. Whether they're actually operating the business or whether they're analysts and investors, which there's quite a few on. You can tell they know their stuff, especially the ones that are very sarcastic. They really know what they're talking about because they've seen a lot of things. They become jaded. And those are really funny too. They're amusing, but there's also a lot of truth in what they're saying. So I think as a new microcap guy, there's a lot of discussion about certain microcap stocks where people will say, "Oh, I met this company," or "I went to the annual meeting." I mean, I see that a lot, and you won't get that from a news service, sell-side research, or others. So there's a lot of things you can do there. Another thing I would say, try and start a business. Even if it's something silly, whatever it is, you'll become much better at asking questions. Because if you have to start a business, you'll say, okay, where does our revenue come from? What are expenses? Who's our vendors? Who's our suppliers? You start to learn all the little questions you can ask. And then when you talk to different companies in that sector, you'll say, oh, who do you guys use for this? Or how are you guys doing this? And you might say, oh, these guys are doing a terrible job. Their costs are so high. And that's when you learn what opportunities there are for improvement, or are they running like a well-oiled machine. So that's something that I would advise. And that's why I think a lot of startup managers are doing a great job, even if it does or doesn't work out, because you learn how the asset management business really works. And okay, what matters to running that business in terms of how much does it cost to hire an analyst? How much does it hire to hire a marketing person? What other things can I outsource? So I think those are the things that I would advise, that if you do any of those, it will lead you to something where you can keep going and maybe find something interesting.
And Chris, where can my audience go and find more information about you and your firm?
Sure. I'm on Twitter at Chris V. Abraham. I don't tweet, but I follow a lot of the other guys. So if you want to contact me through there or reach out to Bobby, I'm happy to talk.
You're retweeting this, though, okay?
I will. There you go. And then at email is info@cvainvest.com.
Chris, I want to thank you so much for joining me today on the podcast, and hopefully see you again soon.
Yeah, had a great time. Thanks.
Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Chris, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official MicroCap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.